Hey everyone, welcome to another video. Yesterday I got a comment about someone asking me my thoughts about the biopharmaceutical company Gilead, and so I'll make a short video response because this is a very interesting company. Gilead specializes in HIV therapies, and historically they've had a very strong HIV franchise. They have by far the largest market share, especially in the US, and we can see that around 55 to 60% of their total sales come from their HIV franchise. Veklury makes up about 20% of their total sales, and this is a new drug that is licensed for COVID. And the last 20% of their sales come from an aggregate of hepatitis C, hepatitis B and D, and cancer cell therapy. So why would you want to buy Gilead right now? After all, the performance of the company has been lackluster since 2015. In 6 years, the stock is down 47%. That's way below the returns of the S&P 500. Well, there are a couple reasons why this is interesting. The first is this super high dividend yield of 4.67%. Gilead started paying a dividend in 2015 and has increased it very steadily every single year since then. And while a dividend yield of 4.67% is quite high, we need to make sure that it is sustainable and that the company is not going into debt just to pay a dividend. And if we look at how much money Gilead spent on dividends last year, it was 3.63 billions on cash flows of around 9.95 billion. If you do the math, that's approximately a 36% payout ratio, which is really safe. Another reason to be excited is the company's super low valuation. While the PE ratio stands at about 17, the price to free cash flow, which can be calculated by dividing the market cap by last year's free cash flow, stands at less than 8. Anything less than 10 is usually dirt cheap. So a price to free cash flow of less than 8 is a wonderful deal. Usually, if a company is trading at this level, it means that investors are expecting the company to go bankrupt eventually. So currently, investors are pricing in zero, if not negative growth for Gilead in the future. What this means is that if Gilead is able to defy all expectations and grow at a very small rate, or even have revenues stay at 0% over the next 10 years, this could be a really good deal. So now let's go into a bit more detail and look at the financial statements of the past 8 years. In the early 2010s, Gilead acquired the HCV franchise and saw a big boom in revenues until 2016-2015. Of course, this was reflected in the stock price, and we can see that around here, the stock price just exploded for a couple of years. The problem with HCV is that it's a disease that can be cured. So once Gilead had treated its patients, the patients did not come back for more treatment. So eventually Gilead ran out of a population to treat and revenues fell back down to earth. From 32 in 2015 to 22 in 2018. That's almost 30% down. And again, this was also reflected in the stock price as it lost 45% in just 2 years. And ever since, Gilead has managed to keep revenue stable again. And thanks to their new COVID treatment, Veklury, revenues have started to uptick again in the past 2-3 years since 2020. The question now is this a new base level for Gilead, or will they come back down to around 22? Free cash flow and net income reflect the revenue going up for a couple of years and then crashing back down. One thing that's really amazing about this company is their operating and free cash flow margins. Just look at these numbers. 40, 50, 60% margins, now coming back down to 30, 40 range. This is still extremely high. The company has managed to buy back some of its shares over the years, but since 2020, these share buybacks have stopped. The 5-year return on invested capital is 17%. Anything above 10% is really good in my opinion. We already went over the dividends paid, and the net debt of $18 billion doesn't really bother me since the free cash flow is extremely high. It would only take Gilead about 2 to 3 years to pay down this debt. When it comes to the model, this is a very tough one to predict just because of the nature of the healthcare industry. If you're going to invest in Gilead, you need to understand a few things. The first being, what is going to happen to Veklury? As I mentioned previously, this drug was specifically brought to market for COVID-19, and as of Q1 of 2022, this drug alone made up 20% of the total sales of the company. As COVID-19 becomes less relevant and infects less people around the world, how will this revenue stream evolve? Will it slowly revert back to zero, or will they manage to do as they say in this slide, as they are expanding indications for COVID-19 treatment? That's for you to figure out, but this will definitely have a big impact on the future of the company. Another thing you need to understand is the pipeline. And on this slide, you can see all of the compounds they currently have in phase 1, phase 2, and phase 3 trials. For example, Gilead has really been looking forward to magrolimab, and when this drug hits the market, this is a treatment for cancer that apparently has a lot of potential. But for now, these applications are being held in standby by the FDA, and who knows when Gilead will be able to start profiting from these treatments. They're looking forward to it as an option for growth, but again, there's always the risk that the FDA will not approve it. And then there's all of the acquisitions that you've got to consider. It's quite normal for big healthcare companies like Gilead to grow by acquisitions. When a small startup lab has a really promising molecule, it can be a good source of growth for these bigger companies. But at the end of the day, you're still taking a bet on that molecule. Usually it hasn't gone through all of the stages of clinical trials, it still needs to get approved by the FDA, and you just don't know how efficient the treatment is going to be. And some of these acquisitions that have happened in the past 10 years have been for quite hefty sums. We can see 12 billion over here, 12 billion over here, 5 billion. So at the end of the day, you need to see, what does Gilead have to show for all these acquisitions? Or is it just wasted capital? The reality is that Gilead operates in an industry where you constantly need to be spending cash flow on acquisitions or R&D. And so that's another risk to consider. Next, you need to figure out which products have patents that are going to expire pretty soon. One good thing about pharma companies is that they usually have strong moats. Once a product hits the market, you usually have a period of about 12 to 15 years where no other competitor can bring a product that is similar to yours. So essentially, that gives you a mini monopoly. The problem with that is that it's very temporary. As soon as the patent expires, generic companies rush in with similar products that are much less expensive. And usually for a company like Gilead, once the patent of a very successful drug expires, the sales of that drug plummet almost overnight. And that's one of the negative aspects of moats in pharma companies. So again, you need to check which drugs have patents that are expiring, and if they do expire, what is the effect on the total sales or on the free cash flow? For Gilead over here, we can see that their main drugs like Descovy, for example, has a expiration in 2025, so that's pretty soon. But another one like Biktarvy, which is a huge contributor to sales, expires in 2033. Veklury, the COVID drug, 2035. Trodelvy, I think, is pretty important, and they expire in 2023. And then for the key product candidates, like we just mentioned magrolimab, this product hasn't even hit the market, and the patent already expires in 2031. And finally, one of the biggest overarching secular risks comes from the US healthcare system directly. For many years now, the government has been fighting for drug pricing policies. One of the reasons Gilead has such high margins is that they operate mainly in the US. And in the US, prescription manufacturers like Gilead are able to charge extremely high prices for their medications, almost without any control. So, no one knows if the government will be successful in passing this policy in the future or when it will pass, but it's definitely something to be wary about for investors in big pharma companies. So again, going back to the model, this was a really tough one to predict. I've gone with a revenue CAGR of 1% and a free cash flow margin of 30% and 0% per year of share buybacks. Why did I use 1%? Well, just to be conservative. As I already mentioned earlier in this video, revenues for Gilead have been really inconsistent, with a big boom in the early 2010s, then a crash, and now slowly upticking again, in part thanks to their COVID drug. So by using 1% revenue CAGR per year, that means that by 2030, so in 8 years, revenue will be almost the same as today, 29 billion versus 27 billion. The free cash flow margin of 30% is also pretty conservative if you look at the historical free cash flow margins. 30% is equivalent to what they achieved in 2020, which obviously everyone knows was the year of the pandemic. And again, for share buybacks, 0% per year is also pretty conservative. Over the years, Gilead has always managed to purchase some of their shares. Since the pandemic, they have been more conservative, which I think is really good. And I'm just going to assume that this keeps going until 2030. If we use a terminal free cash flow multiple of 11, that's 8.96 billion times 11, and that's 99 billion market cap by 2030. As we already said, the share count will still be 1.26 billion in 2030. And so if you divide the total market cap by the number of shares, that's $79 per share. So based on this price target, the dividends, and the share buybacks, these are the returns you can expect from buying at these stock prices. So today, shares of Gilead are at about $63 per share, which implies a 7.5% return over the next 8 years. And the key with this valuation model is optionality. The fact that this valuation model is extremely conservative implies that there will be no new products hitting the market, no new blockbuster drugs for Gilead in the next 8 years. It also implies that the R&D will be very unsuccessful, there will be no new acquisitions, no new molecules, blah, 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 blah. If you use these assumptions in your model, it means that as soon as Gilead manages to find a blockbuster drug, revenues could skyrocket. From 1%, they could start growing at 15%, say. And if that happens, the multiple would definitely expand too, from 11 to 15, 18, who knows. And if that were to happen, your expected return could be a lot higher. The reason why I haven't invested in this company is that to me, it feels like a melting ice cube. Every year, lots of free cash flow is spent on R&D and acquisitions that so far have proven to be unsuccessful. And to get above average returns, you're really relying on a catalyst like a new successful molecule hitting the market. At the end of the day, I don't think this is a bad investment. With these conservative assumptions, you can still expect an average return. And in this market, an average return is pretty good. All in all, I think the risk-reward ratio is pretty good, but this investment is just not aligned with my philosophy. But remember, just because it doesn't fit me and my goals as an investment doesn't mean that it's not for you. We all have very different goals, time horizons, strategies, etc. On that note, I hope you got some value out of this video. Make sure to subscribe to the channel to see more videos like this. Leave a like and a comment to support the channel, and I'll see you in the next one. Peace!